Hello everyone, it's Professor Reiko here again. Today we're going to go over the effective interest method, which we did that in the last video, but this time we're going to do it with the discount. So hopefully you watched the previous video on the effective interest method dealing with a premium for a bond, but now we're going to do it for a discount. But just to recap quickly, remember our steps here. The first thing we're going to do is compute bond interest expense. We do that by multiplying the carrying value at the beginning of the period by the effective interest rate, which is the market rate. Okay, we're then going to get the discount or premium amortization by comparing the bond interest expense that we just calculated up there in the first part to the interest to be paid, which is what we calculate at the very beginning of a problem, by taking the face value right here times the stated rate. So this is the interest payment, and this right here is the interest expense. So basically number 3 here is just restating what is said in number 2. All right, so let's look at our bonds here. All right, so we've got $100,000 bonds, 8% 10-year bonds. They pay interest semi-annually. Okay, so we've been using these throughout these same bonds. We've just been changing the market rate and how we do the amortization. The interest rate is 10. All right, so notice these numbers are already filled in here. So those numbers were calculated in prior videos, okay, using our present value calculator. But what we did to do that is we said, all right, let's get the payment first, 100,000 times 8% times 6/12 equals 4,000. All right, so remember the issue price of a bond is the present value of the two cash flows, which are the principal and the interest. So we would have used the future value in our calculator would be 100,000. The annuity, the payment would be 4,000. We would have used its 10-year bond, so N would be 20 because it's 26-month periods, and the market rate would be 5% for the 6-month market rate. All right, so what that means is right here, this is 4,000. All right, all the way down. And this is a typo. I did this in the other video as well. That's 12/31/17. So sorry about that. All right, so remember, up at the top there, it says interest expense right here. Column B is calculated by taking the beginning of the period carrying value times 5%. All right, well, our carrying value is right here, column E. So we take that 87,538 times 5%, we get 4376. All right, column C here, our amortization amount is just the difference between A and B. So that's going to be 376. All right, columns D and E are just subtotals. So D is essentially my T account for the discount or the premium, keeping up with what is unamortized. All right, your book does not do that, but I like to have it there. And then remember, my definition here is face value, 100,000 less an unamortized discount. So 100,000 less the 12,086 gives me 87,914. All right, let's do the next one. All right, so now we're going to take the 87,914 times 5%. That gives us 4396, which makes this 396. So that will be our journal entry numbers. Our unamortized amount is now 11,690 because we amortized 396 more, which brings this 88,310. Let's do one more row. This would be 4416, which makes this 416. Bringing this to 11,274 and bringing this up to 88,726. Okay, so as I pointed out in the previous effective interest video on the premium, notice this column D is always going to 0 because we're amortizing something down to 0. Column E is always going towards face value. So in the premium one, it started above 100,000, was going down. Here it starts below 100,000, is going up. Okay, so make sure you're aware of that because I pointed out that can help you answer a multiple choice question. If I asked you interest expense when bonds are issued at a discount is what? Well, you can see here it's always going, these numbers are always increasing. And the reason they're increasing is because we're multiplying this carrying value, which is also increasing. Okay. All right. So our journal entries. So on 1/1/17, we issue the bonds. All right. So this is no different than what we did earlier. We have cash for the issue price, 87,538. We have a discount on bonds payable for the 12,000, and that's 12,462. And then remember, bonds payable is always going on the books at face value. Okay, so 100,000. On June 30th, We make our first interest payment, so we're going to have interest expense for the $43.76. We're going to amortize our discount on bonds payable for $3.76, and we'll have our credit to cash because we're actually cutting the checks and sending it to the investors that bought our bonds for $4,000. All right, it asks for one more, 12, 31, 17. Now notice it's still going to be the same entry, right? Interest expense, discount on bonds payable, and a credit to cash. All right, the credit cash is still 4,000. The other two numbers changed. Let's go up to the table and grab those, 43.96 and 3.96. All right, and then this process would just repeat itself over and over and over again until we got to the end of the life of the bonds. Okay, so hopefully this has helped you. So the previous video, we did the same thing, except that was with a premium on bond payable. This one's a discount, so that should give you a pretty good idea of what to expect using the effective interest method to amortize your discount or premium. All right, so hopefully you enjoyed that. Tune in next time as we'll do another example and then start moving on into the retirement of debt and things like that in the next few videos.